Today we'll be talking about disinflation before Fed pivots. I do want to point out one thing. So over the past video and also this video, we talk about a lot about inflation. And in terms of what I'm trying to reference is, the increase in prices and also the official inflation rate. But I do want to point out one thing that, actual inflation in terms of kind of Austrian economics, definition, or the original definition, if anything, it is the increase of money supply. And what happens is, as we change the definition of increase of money supply, because prices can't inflate, prices rise and it increases, and what inflates is money supply. And as we change the definition of what inflation means, and when we try to give solutions, like stuff like price control, it doesn't solve the problem, because those solutions are not tailored to what the underlying problem is. The underlying problem is increase of money supply, and until we use solutions that are tailored to dealing with the increase of money supply, like just decrease the money supply, we won't solve the issue of inflation. And I just wanted to kind of point that out before anyone kind of get confused about what I'm talking about in terms of inflation. These are the topics we'll be going over today. First off, we'll talk about the recent G7 meeting and also the BRICS meeting. Then we'll talk about what's happening in the bond market, where it looks like it's kind of interesting dynamic where the primary market, meaning just between the US Treasury and its primary dealers and also other qualified investors, it continues to look bad over the past two auctions, while the secondary market is looking to have support. And we'll talk about why that is the case, meaning there's not a lot of people willing to buy from the primary market. However, there's seem to be demand in the secondary market. Next up, we'll talk about the stock market, and it looks like it's beginning its second leg down. So first leg down is from liquidity shrinking, not enough buyers, and now we're looking into more fundamentals where earnings forecasts potentially going to be downgraded, and actual earnings will also be lower, so meaning the underlying economy is not doing too well. Next up, we'll talk about real estate, where finally we're getting data that real estate is starting to come down, and it looks like May might be the highest point. We'll see. Then we'll talk about commodities, whereas inflation expectation continues to fall, and the recession again, that is another thinking that we're already in a recession. We'll see once we get the data for 2022 Q2. and as recession continues, commodities should see a downward pressure, and obviously the leading indicator being oil as the big component. And finally, we'll take a look at future outlook. Most likely, again, in recession, we'll see once it will be confirmed once we get the Q2 GDP data. And finally, again, going back to the idea disinflation will provide cover for Fed to pivot after midterm election. And in terms of the pivot timing, meaning they'll first stop tightening and then potentially return back to easing. Potentially, I know previously we thought it might be 2022 Q3 to Q4, but we might have to drag it out to 2023 Q1 and not just 2022 Q3 and Q4. Now, G7 versus BRICS. So G7 is the modernized Western industrial countries. And in the recent meeting, it looks like U.S. is trying to shift the focus away from Russia and move it towards China, meaning all the sanctions, all the different kind of countering measures. We're trying to shift the focus away from Russia into China. It's kind of interesting where Germany, one of the members, is actually showing willingness to work with China. And what this is showing is, is that there could potentially be a lack of unity between the G7 countries. And instead of holding a united front against, China, they, Germany is showing like, maybe working with China will give me more benefit versus, going against them. And finally, this is just the kind of funny part, hypocrisy, where they're talking about a $600 billion of infrastructure investment plan. And it's funny because we already have high inflation. And central banks have finally admitted that it is a demand issue, meaning there's too much, excess demand from, money printing, more money chasing, a fixed amount of goods, or, with supply chain, you kind of decrease as well. That it is a demand issue. And if we're just pumping more money to increase demand, that means more inflation. But I thought we were trying to fight inflation. So I thought this was kind of, funny. And now BRICS also had a recent meeting. They're inviting more additional representatives from different countries. This is interesting because now we're seeing, two kind of big parties potentially going against each other. And now we're seeing different countries starting to pick sides. Which way are we going to go? Are we going to lean towards G7? Are we going to lean towards BRICS? And BRICS meeting also talked about more collaboration, so maybe less reliant on some of the resources and trade needed from, G7 countries. So again, we're seeing two independent, potentially developing independent, groups. And this is something to continue to be observed. So now let's talk about the bond market. So as mentioned before, the primary market is lacking interest, where we're seeing primary dealers. So usually the big banks or institutes that, buy it from the US Treasury via auction, and they resell it to others. And there's also parties that just buy it and hold it themselves instead of reselling. But we're seeing that primary dealers, or their percentage of issuance is actually increasing, meaning there's no other buyers, but only the primary people who are buying and reselling. And so this is something to, continue to watch, but it looks to be the case where there is lacking other buyers like other central banks. It's really just the big banks in US that are buying and reselling it. When we take a look at the secondary market, now we're actually seeing more interest because the risk premium between US Treasuries and stocks are decreasing. So what happens is stocks are more risky, and in order to entice investors to buy stocks, there should be a risk premium. But as the risk premium decreases, for example, let's say you're comparing to a stock that pays dividend, or we're just looking at the PE ratio. As a stock dividend either stay the same or doesn't move, but we're seeing bond yields are increasing in a very rapid rate. And what happens is the risk-adjusted return would favor the higher yield US Treasuries. It doesn't have to have a higher yield than dividend yield, but what happens is there's risk involved, right? Because supposedly US Treasury, which is kind of funny, is risk-free. My opinion, it's not risk-free, but in because of inflation risk and default risk. But theoretically, they're supposed to be risk-free. And then you compare it to equities, where there is more, you take on more risk with the dividends, because maybe earnings doesn't come out as well, maybe management doesn't keep the same amount of dividend, so on and so forth. And so as that gap shrinks, then there's more incentive in buying U.S. Treasuries. And another thing, with recession, a lot of investors are thinking, with recession, inflation will come down, and therefore, you should just buy U.S. Treasuries and not have to worry so much about higher inflation rate to kind of erodes your fixed income. And so that's what we're kind of seeing in the secondary market. Now let's talk about the equities market. So as mentioned before, we are again in a long-term bear market. So what we saw in June, in the last week, was we have a nice little rebound, and a lot of people are calling bear market over. My thinking again continues to be that we are in a long-term bear market, and therefore we're not going to have big, massive, like monthly drops. But what happens is, if we have a big drop, we'll have a small rally, but then continue with the leg down. So any rebound, I would not trust, but rather its potential, adding more shorts instead of thinking that the bottom is in. And then, so I think the first leg down from in terms of lack of liquidity has popped, and what we're moving into is the second leg, where we're going to see earnings forecasts to start to be downgraded, and we'll see actual earnings to be lower, given the recession, as recession continues to develop from lack of demand. And again, the lack of demand is from additional artificial demand from a lot of money printing and a lot of stimulus check, and that is not being continued, and therefore again that's why we're seeing a lower demand. And also companies anticipated that all of that demand would be continuous, but again obviously that's starting to not be the case again, as we look at retail sales, and as we look at other consumer confidence data, that we're seeing that, and along with inventory levels, we're seeing that companies are stocked up way too much, anticipating the demand to be continuous, but obviously it is not. And so therefore earnings will start to come down, and this will hit retail the most, given they're more oriented around sales and inventory. Next up, we'll talk about real estate. As mentioned before, we saw that the volume started to come down from beginning of the year, even though price continues to rise. So meaning there's less trade going on, even though prices are going up. Now we're finally seeing the rate of price increase is falling, and it shows that March was the highest point in terms of growth point, and that so as your growth starts to fall, that's when we're seeing, we've seen the peak. Again, we might get one more bounce in terms of real estate price if the Fed pivots, and that's something we'll see. But otherwise, in terms of like a great buying opportunity point, meaning like we're trying to mark the bottom, I do expect it to be 2023 to 2024. Now let's talk about commodities. Now, as inflation expectation continues to fall, again, the inflation expectation, this is something that's being traded by bond traders with the U.S. Treasury, with the fixed rate and also tips. And as recession continues, demand is expecting to fall, and therefore inflation expectation is also falling. And one of the key commodities to watch, with the CRB index, is oil. And obviously, again, Biden needs lower oil price, which will help with the whole inflation narrative. And so that, again, that's why you see him going to meet Saudis in July. And Saudis have promptly mentioned that, I'll help you, I accept your, coming forth. And they have announced, decrease output towards China, which, again, China wouldn't have any issue with it because they'll just buy it from Russia. And another point being if Saudis are actually able to increase production, that will bring down oil price, and that is again something that is favorable to China because China uses a lot. And if we do see a drop in commodity prices, which could help, which would help the inflation picture because energy is part of a component, that should provide cover for a Fed pivot. Precious metals, again, we're waiting for DXY to weaken and obviously the Fed pivot. The short-term risk is the downside with commodities as a whole continue to draw down with recession and inflation expectation falling. However, again, I think that's something to continue to observe. Once Fed pivots, precious metals are ready to go, and the resilience that we're seeing so far, is another strengthen point for the narrative. Finally, let's wrap up with future outlook. And again, the stagflation idea is still here, where lack of economic activity will not decrease in terms of inflation. So I know it sounds kind of interesting how I talked about commodity prices. I expect it to fall. However, what I'm thinking is with the whole supply chain and with even if commodities inflation, like commodities prices come down, I think structural inflation is still here to stay. Meaning, other things like wages, increased cost from zero carbon emission initiatives, and other reasons like decrease of international trade, geopolitical risks. Those are things that will continue to put upward pressure in inflation. And the risk is, what if the commodity price is falling? So that's something that, for example, Biden is trying to do with oil. What if oil prices fall but inflation doesn't fall as much, or it doesn't fall at all? That will be an issue. That will be really hurtful when it comes to the economy, because now we're seeing oh, okay, so even if commodity prices fall, inflation rate's not coming down. So that's something to continue to be observed. Again, I think the right thing to do is to just let everything fall. But again, I don't think Fed at this point want ultimate collapse, and I think that's why they'll try to kick the can down the road one more time, and that's why I think they'll pivot one last time until they absolutely have to, and that might be another Volcker moment. And so again, we're most likely already in recession, definition 2 quarters GDP negative, and we see Q1 GDP is revised to minus 1.6. We're still waiting for Q2 GDP, obviously. June hasn't even been over yet, but I do expect it to be negative given all the other data that has been out so far. And we're thinking of potentially disinflation, meaning I'm not expecting deflation, meaning prices to come down, but at the same time I do expect a lower inflation rate, meaning the prices are still increasing but at a lower rate, meaning it's increasing at a decreasing speed, but not deflation. And this will provide cover based on the base year effect, because last year inflation was really high. So you would compare it to this year, or if all of a sudden inflation rate's not 8.6, if it comes down to maybe 4 or 5%, maybe it'll provide cover for Fed to pivot after the midterm election. Then again, this is the idea that I keep talk about, is that we'll have one last rally before the ultimate collapse, where Fed has to hike rates to and will be put into the Greater Depression in order to protect the value of the U.S. dollar. Otherwise, then so the path is either collapse, all prices, or collapse of the currency. So that's a tough decision the Fed will have to make, but I think they will try to save the currency in the end. So to kind of summarize, thinking-wise, when it comes to different asset classes, I think bond market, secondary market, I think I do expect yields to come down just for the time being, given again due to recession, and also the risk-adjusted reward is more favored to bond market rather than equities market, because again, earnings are coming down, dividends might be cut, while bond market relatively have higher yields now, risk adjusted. Equities market, again, I'm thinking it's beginning its second leg down. This is from EPS adjustments. Earnings are going to start coming down. Earning forecasts are starting to come down. Real estate already on its first leg down. Again, this is because higher rates makes it so not a lot of people can afford as big of a mortgage, and also the Fed tightening is part of the shrinking of funds available for real estate. And then finally, commodities are starting to fall. We're seeing agriculture crops prices to fall. We're seeing oil, it kind of peaked out at 120. We got to continue to watch if oil will continue to mark its way down, and I think that is that is something that will continue to happen. The target so far, I don't really have one, but maybe 90, 80. But I think once it breaks below $100, that's really the key signal. Thanks for watching.